Hi, everyone. Today I'm joined by Chris Callahan of Excalibur Capital, and we have a wide range of topics to cover today. We're going to talk about the lending environment. We'll talk about M&A. We'll talk about construction, and maybe a few other topics may sneak into today's conversation. But welcome, Chris. How are you doing?
Doing great, Ben. Thanks for having me.
Awesome. Very happy to have you here. I wanted to start just with a curiosity of mine. Last year the seniors housing market really kind of dominated the M&A transactions in skilled nursing. While buyer demand was certainly there, there just weren't as many deals that were getting done or getting financed. So I'm curious what Excalibur's breakdown is between SNF and seniors housing assets in your portfolio, and do you want to change that, and why?
Sure. I'd say right now we're probably, right around 50-50. We may, have slightly more on the SNF side at this point in our servicing book. I kind of like, I kind of like having, a little bit of balance there. We're not necessarily married to any percentage per se. It's more, kind of the deal coming in, who's the operator, leverage point, things of that nature. So we're more just kind of looking for good credits to invest in and to service.
Mhm. And did you see a lot of the same thing, like on the M&A side, just did not finance as many SNF transactions last year?
We financed a decent amount on the SNF side last year. Yeah, there was certainly some M&A. I mean, there were also some rescue capital type deals with folks coming a little bit slowly out of the pandemic. But yeah, we still kind of did our fair share on the SNF side for sure.
Okay. And so you see that 50-50 balance kind of continuing in the next couple of years at least.
Yeah, I think so. I mean, barring any major massive transactions which would maybe skew it one way or the other, but as of now, I would say it's probably going to be around 50.
Yeah, awesome. And then of all the types of debt, turning to the debt markets, where do you see the most activity right now? Is it HUD? Is it the bridge space, or USDA, CPACE kind of taking a larger share?
Yeah, I mean, we've been ramping up our USDA and our pay side, so that's going to be a a higher percentage kind of going forward of kind of our overall transaction volume. But I would say as we target this year, we're probably going to be, if we were to break down kind of the different sectors or verticals that we have, I would say we're probably 40-ish% will be on the bridge side, 20 to 25% on the HUD side, and then the other two USDA and Pace would take the probably the balance of that. So 15 to 20% on those.
Mhm. And any of those financing structures, do you either want to increase your closings in those certain areas, or do you think any of those structures are underutilized by borrowers right now?
Well, yeah, I mean, in terms of what we want to do, again, we really just I guess we don't go and set out and say, hey, we want to do X amount of USDA. It's more what's the opportunity out there? What's the best product for the best solution for the problem or what we're trying to solve for. That being said, I do think that the PACE side and the USDA side are not as widely understood and are underutilized, and I think that's why you're going to see our volume and others' volume in those two sectors grow over the next several years.
Mhm. And something that I've been hearing consistently is that when lenders are talking about the deals that they've been doing, especially during the pandemic, they always reference, oh, we work with high quality operators with best in class communities, and it just seems like those kind of operators have absolutely no difficulty throughout the pandemic in obtaining debt, and it makes sense, obviously, but they're not all owners or operators are like that. And so what about those other owners and operators of those C and even B communities that are struggling right now?
Yeah, sure. I mean, I guess the way we look at it, we don't necessarily shy away from B or C communities. Uh, Operators that maybe don't have the the operational reputation that we would look for, we would shy away from. But if you have an operator that, has shown, a good amount of success in the past in that geography, doing that sort of turnaround, we'll finance those folks all day.
Hmm.
It's more, if you have yeah. So I guess another way to say it, I'd rather finance a B or C property with a great operator than an A property with an operator that maybe isn't.
Hmm. Got it. But can they expect? Can those B and C property owners expect different rates and terms than those A communities?
Yeah, I- it's really a function of of the leverage point. What percent recourse are we talking about?
Hmm.
The how deep or how big of a of a turnaround is it? Because the way we look at it, we kind of look at each. We price risk according to kind of how we see it. So if it's a big turnaround, that's going to take multiple years. We'll price something obviously higher than something that's class A with a class A operator that's stabilized.
Hmm.
But we can price for all that stuff. We will tend to stay away from operators.
Got it. And are you doing non-recourse bridge financing as well right now?
Yeah, we'll do both. We'll do recourse and non, and again, some of that's a function of the leverage point, the operator experience, and which state we're in.
Mhm. And so for financing M&A transactions, are there certain deals that you just won't do right now?
No, I think we'll again, and we're so levered to really, who's the operator, who's the boots on the ground,
Hmm.
and if we're good there, then we're happy, kind of going forward with the transaction. I would say we look at we don't have any kind of bright red lines like, hey, and we're not going to do that, not going to do that. It's just kind of deal by deal for us.
Hmm. But I imagine there are certainly some cases where you say no, though.
Oh, for sure. No, but I would say it's not. Yeah, we do say no, quite often.
Yeah,
But it's more a function of we can't get comfortable with the trajectory from point A to point B.
got it. Yeah, that the trajectory is something that we've been kind of harping on lately, just because it's been our feeling that there's a little unbridled optimism in the industry, considering all of the headwinds that are facing in it. So, any occupancy predictions for the next couple of years, some, if not most, will probably have to drag that out at least another couple of years just to get back to whatever pre-COVID occupancy levels there are. And like, there's a whole other discussion about is pre-COVID occupancy levels, is that healthy? Because I'm sure the industry wanted to get to a better place in late 2019 there than where it was.
Yep.
But so, what about financing renovation projects? Just because I imagine there's a lot of deferred maintenance out there right now, not including what providers have to do to adapt to new infection control measures or even changing tastes in residents.
Yeah, I mean, we're definitely seeing that, and I would say, a lot of time. I mean, clearly you'll see it on an acquisition, right? Someone will come in and say, okay, I want to do A, B, and C of capex, and then we'll reserve for that, and they'll go ahead and do that. But we're also seeing it on a number of packages coming in where folks have loans that are maturing in the next 6 to 8 months, that with some other lenders, and like, well, yeah, we're gonna refinance this thing out. Here's our trajectory from point A to point B. But we also have, as you said, deferred maintenance. We have, a couple things that we haven't really gotten around to the last couple of years. So they're, inevitably looking for packages to, refinance your existing loan that, originally was maybe a bridge to HUD, and then hit the pandemic and now need more time. And as long as they are doing the refinance, kind of makes sense to, kind of try to get those additional dollars to make those improvements, in order to kind of hopefully increase the likelihood of getting occupancy higher and even.
Hmm. And I know it's been referenced a lot that new construction levels have definitely dropped during the pandemic for a variety of reasons. But I'm just curious if you've been seeing a number of expansion projects come across your desk that in need of
Um,
financing.
Yeah, I mean, in terms of ground up, we've certainly seen some there, and we kind of use our USDA platform for that. But we will use our bridge platform for for some gut renovations or potential. I would say smaller expansions that we'll do on the bridge side. But yeah, we're certainly seeing that for sure. There's probably not as much capital available for straight ground up these days than there was even I guess back in 19. But to the extent they're in rural areas, we'll do that with our USDA.
Got it. And then the recent quarter point increase in the federal funds rate. I just want to get your reaction to it. Then I also just want you to just lay it out for me in layman's terms. How will it affect your current business, and how will it affect senior care M&A or the construction market? Taking into account likely future increases as well.
Sure. I mean, I guess what I would say when we're sizing, our bridge loans and acquisition loans, things of that nature, we're really solving for the, inevitable, permanent takeout, a
Mhm.
year, 2 years, 3 years out. And that's really, more a function of the longer end of the curve, the 10-year note, things of that, the kind of that, part of the yield curve. And that's also, in some respects, driving cap rates as well. So I
Mhm.
would say I'm more watching the longer end of the curve. Clearly, short-term rates, going higher by 100, 150 basis points are going to affect folks' cost of capital. But to me, it's more, it, it would behoove more folks to watch the longer end of the curve because that's what's really going to drive their returns on a longer term basis.
Mhm. And how are you reacting to changes in the 10-year?
Yeah, I mean and it's less of an issue, certainly on the SNF side, but less so on, or more so on the assisted living and memory care side. But when we one of the constraints, obviously, as we size our loans is their ability to cover debt service when we inevitably kind of do the longer term takeout. HUD rates are effectively set from their cap rate, so on and so forth. So, yeah, we're certainly looking at it. I think it's more of an issue right now on the multifamily side.
Mhm.
In turn, we're having some tight coverage issues, but yeah, I mean, we're certainly, we're certainly very aware of it. We have kind of our early rate lock plan that we do or offer on the HUD side to some folks to kind of try to mitigate some of that interest rate risk.
Mhm. And this next question should definitely have different answers for SNF buyers versus seniors housing buyers. But how should buyers react to this rising rate environment?
Yeah, again, I, sorry. I guess our thought is, if it's going to be 100 or 150 basis points, and clearly you have to solve for that in your cost of capital and your levered return, depending on how folks are financed.
Mhm.
We're at this point we're not looking for 200 to 300 basis point shocks. I think that's something that could certainly potentially slow down growth, could hurt cap rates, and that's something I would be certainly cognizant of. If things were to progress there, but in the base case, we kind of see kind of gravitating between 100 150 basis points, and we don't think that's going to slow things down too much at this
Got it. And lastly, I just want to touch on Excalibur. So, what do you have planned for 2022 and beyond?
Yeah, so I think we're going to continue to kind of grow organically. I think we've got 55 people across the platform now, which is up pretty dramatically year over year.
Hmm.
Kind of continue to increase the servicing book. As I mentioned, kind of continue to focus on not only the HUD and bridge to HUD, but also USDA and CPACE as our view is kind of underutilized financing tools that are pretty interesting. And then we're out there kind of currently fundraising for our next fund, which we're super excited about. Kind of really focused on communities and impact. And one of the beauties of kind of having these four, the HUD, Bridge, USDA, and CPACE food groups, is they all kind of hit kind of the impact kind of focus that we have. So to kind of raise around that, for this next fund, we're super excited about that.
Awesome. Well, I'm sure we'll be covering all of your transactions for the rest of the year and the next couple of years, and very, very excited to see that volume just keep increasing. But Chris, thank you so much for your time today, for your insights. Thought it was a great conversation, and would love to do it again. Also,
for sure. No, thanks so much for having me, Ben.
Thanks, Chris.
See you.